Picture this. It's late at night, and you're sitting at the kitchen table with a steaming mug of your favorite tea. You're contemplating your financial future, wondering how to make your money work for you. Maybe you've heard the saying, "Don't put all your eggs in one basket." But let's dig a little deeper into what that means when it comes to investing. We're talking about diversification, a fundamental strategy that can help you manage risk and build long-term wealth. Imagine your financial life as a garden. Each investment you make is a different plant. Some are sturdy oaks that grow slowly but surely, while others are delicate flowers that bloom quickly but may not last as long. If you fill your garden with only one type of plant, you're at the mercy of the elements. A single storm could wipe out your entire garden. But if you have a diverse array of plants, some will inevitably thrive no matter what Mother Nature throws your way. Similarly, a diversified portfolio spreads risk across different asset types, sectors, and geographies, so you're not overly exposed to any one potential financial storm. Let's break this down with a real-world example. Think back to the 2008 financial crisis. Many investors who had heavily concentrated in real estate or financial stocks saw their portfolios take a massive hit, but those who had spread their investments across different asset classes like bonds, international stocks, and commodities were in a much better position. Diversification doesn't guarantee against losses, but it can reduce the impact of volatility. Now let's talk psychology for a moment. It's natural to feel the pull of greed when a particular stock or sector is booming. Remember the dot-com bubble? People flooded into tech stocks, driven by the fear of missing out. But what goes up quickly can come crashing down even faster. Diversification helps keep your emotions in check by mitigating the impact of market swings, allowing you to sleep a little easier at night. Another way to think about diversification is like building a balanced meal. Each food group offers different nutrients, and it's the variety that nourishes your body most effectively. Similarly, a mix of stocks, bonds, real estate, and maybe even a touch of alternative investments like precious metals or digital assets can provide a more balanced financial diet. That said, diversification isn't just about spreading your money across different types of investments. It means considering factors like the industries you invest in, the geographical locations of those investments, and even the market capitalizations of the companies you choose. Each layer of diversification adds another layer of protection and opportunity. Don't make the mistake of thinking more is always better. Over-diversification can dilute your returns, and you might end up with a portfolio that's overly complex and hard to manage. It's like adding too many ingredients to a recipe. The flavors can get muddled. Strive for balance and clarity. So as you're evaluating your portfolio, ask yourself, am I relying too heavily on a single asset or market? Are there ways to introduce more balance without spreading myself too thin? Remember, the goal isn't to avoid risk entirely, but to manage it wisely. As you sip your tea and ponder these ideas, think about the long game. Building wealth is much like tending that garden. It requires patience, care, and a willingness to adapt as conditions change. Diversification is one of those timeless principles that can help you stay grounded, even when the financial world feels wild and unpredictable. In the end, the best investment you can make is in your own knowledge and peace of mind. So take that first step, however small, towards a more balanced and diversified portfolio. You'll be nurturing your financial future, one thoughtful decision at a time.